Most people think that managing money is about intelligence. They believe that to be successful with money, you need a financial degree, advanced calculations, or inside knowledge of how the stock market works. But Morgan Housel offers a different truth. Success with money is less about how smart you are and more about how you behave. Behavior, your patience, your discipline, your ability to stay calm in uncertainty, is the true foundation of wealth. There are countless examples of individuals who were highly educated and intelligent, yet struggled financially because they lacked emotional control. At the same time, there are people who never studied finance, never tracked every economic trend, and yet they quietly built comfortable, lasting wealth, simply by saving consistently, avoiding major mistakes, and letting time work in their favor. Money decisions are made at the dinner table, during late-night worries, and in moments of excitement or panic, not inside a perfect spreadsheet. That's why managing money is about character, not calculations. Another powerful point Housel makes is that wealth is what you don't see. When someone drives a flashy car or posts about a luxury vacation, it's easy to assume they are wealthy. But often, visible wealth is funded by invisible debt. True wealth, the kind that offers freedom and security, is usually hidden. It's the money left unspent. It's savings accounts, investments quietly compounding over time, and financial security tucked away for the future. This idea changes how we think about money. It's not about showing success. It's about building stability. Financial behavior is especially hard because we all come from different experiences. Someone who grew up during economic hardship will naturally view money differently than someone raised in prosperity. Our views of risk, debt, saving, and investing are shaped by the environments we grew up in, the stories we heard, and the personal experiences we lived through. Understanding that people make different financial choices because of different life experiences builds empathy. It reminds us that financial decisions are personal, and that no single path fits everyone. Housel also emphasizes that the hardest financial skill is getting the goalpost to stop moving. We often tell ourselves, "I'll be happy when I reach this amount," or "when I buy this house." But once we get there, we move the goal further. We want more. We chase higher salaries, bigger homes, better lifestyles, and the cycle continues endlessly. This constant shifting of goals creates frustration, envy, and dissatisfaction, no matter how much we achieve. Learning to recognize enough is critical. Knowing when you have sufficient savings, when your lifestyle meets your real needs, when you don't need to keep chasing more, that's real wealth. Because if you can't ever feel satisfied, no amount of money will ever feel like enough. Finally, Housel reminds us that success with money is not about making one or two brilliant decisions. It's about avoiding catastrophic mistakes and letting time compound the results of mostly good, steady choices. The best financial plans are simple and durable. Save consistently, spend less than you earn, invest patiently, manage your emotions, and stay in the game for a long time. Behavior over brilliance, patience over perfection, consistency over chasing the next big thing. That's the true psychology of money. One of the most dangerous habits when it comes to money is trying to copy other people's paths. We see someone succeed, and we assume it's because of specific decisions they made. The stocks they picked, the business they started, the career move they took. We also see people fail, and we assume it's because they made bad choices. But Morgan Housel reminds us that luck and risk are powerful forces in every financial story, and they're often invisible from the outside. Two people can make nearly identical decisions and end up with completely different results, not because one was smarter or more disciplined, but because one got lucky and the other didn't. Likewise, someone might do everything wrong and still win big, while another does everything right and loses. To illustrate this, Housel shares the story of Bill Gates and his classmate Kent Evans. Both attended Lakeside School in Seattle in the 1960s, one of the few schools in the country with access to a computer at the time. Bill Gates went on to become one of the richest men in the world. Kent Evans was just as smart, just as driven, but he died in a mountaineering accident before he had the chance to build his career. Same environment, same opportunity, two radically different outcomes. That's the power of luck and risk. What this teaches us is humility. We should never judge someone's success or failure too quickly. We should also avoid assuming that what worked for someone else will automatically work for us. When you copy someone else's strategy without understanding the context, you may be applying a solution that doesn't fit your situation. Worse, you might be following someone who succeeded through luck and assuming their strategy was skill-based. The truth is, no one has full control over their outcomes. So instead of obsessing over what others are doing, it's more valuable to focus on financial behaviors that work in most situations over time, like saving consistently, avoiding unnecessary risk, and staying patient. Another lesson Housel emphasizes is the idea that you can be wrong often and still do well, as long as your wins are big enough to cover your losses. This is especially true in investing, where not every decision needs to be perfect. If you make 10 decisions and 7 of them don't work out, but the 3 that succeed do so in a big way, you'll still come out ahead. This is how many successful investors operate. They don't try to be right all the time. They try to be right when it counts. The takeaway is not to avoid mistakes at all costs. It's to position yourself in a way where your losses won't destroy you, and your wins have room to grow. This mindset also changes how we define success. Wealth isn't the result of perfection. It's the result of a system that tolerates failure, rewards patience, and gives you time to let your good decisions play out. There's also a powerful truth in the idea that not all outcomes are deserved. Sometimes people succeed because of timing, connections, or pure chance. Sometimes they fail because of circumstances outside their control. That doesn't mean we shouldn't strive to make smart decisions. It means we should stay grounded and realistic about how unpredictable life can be. We live in a world that celebrates visible success. We admire billionaires, follow celebrity entrepreneurs, and consume story after story of those who made it big. But the stories we don't hear are just as important. The quiet stories of people who made good decisions, lived below their means, stayed disciplined, and built modest but secure wealth over time. Those stories are less glamorous, but far more common, and far more useful to learn from. The goal, according to Housel, is not to become obsessed with trying to match someone else's path. The goal is to understand the broad patterns that tend to work well over time, and to apply them in your own way, based on your own situation. Because money, like life, isn't fair. But with the right mindset, you can build a system that increases your chances of long-term success, without depending on luck, and without pretending you can avoid all risk. When we think about building wealth, the focus is usually on how to make more money. We hear advice about increasing income, starting a business, or investing in the right assets. But Morgan Housel argues that the most powerful financial tool is not earning more. It's saving more. Savings is the foundation of financial freedom, and it matters far more than we tend to realize. One of the most important ideas in the book is this: your savings rate is more important than your income or investment returns. It's easy to assume that the only way to become wealthy is by making a lot of money or achieving exceptional investment returns. But both of those are hard to control. Income depends on your job, your industry, your timing. Investment returns depend on the market, which is unpredictable. Savings, on the other hand, are almost entirely within your control. You don't need a 6-figure salary to save. What you need is the ability to spend less than you earn, consistently. There are people making $300,000 a year who are broke, and people making $50,000 who are financially secure. The difference isn't income. It's behavior. A high income with high spending leads to the same place as a low income with high spending: financial stress. Wealth is not about how much you make. It's about how much you keep. Housel emphasizes that saving money isn't just about preparing for emergencies or big purchases. It's about creating options. Savings give you flexibility. They give you time to think, space to breathe, and the freedom to walk away from bad situations. You might not know what you'll need money for in the future, but that's exactly the point. Life is unpredictable, and savings are your buffer against uncertainty. You don't need to attach every dollar of savings to a specific goal like retirement or a house. Saving simply for the sake of having financial flexibility is a worthy goal on its own. It's easy to overlook the value of saving because it's invisible. No one congratulates you for skipping a vacation. No one sees the car you didn't buy or the expensive dinners you didn't attend. But those quiet decisions are what build wealth. In a world obsessed with showing success, saving is a silent act. It's about choosing long-term security over short-term appearances. Another powerful point Housel makes is about freedom. He says that money's greatest value is the ability to control your time. When you have money saved, you're not forced to take a job you hate. You're not stuck in a situation because you can't afford to leave. You can choose what to do with your day. You can say no. And that kind of freedom is hard to measure, but it's incredibly valuable. Too often people equate wealth with material things, expensive houses, luxury cars, designer clothes. But those things come with ongoing costs, maintenance, stress, and the pressure to keep earning to sustain the lifestyle. Real wealth is different. Real wealth is about peace of mind. It's about not worrying if the car breaks down or if the economy takes a dip. It's about having space between you and the edge. This leads to another important concept, lifestyle creep. As people earn more, they tend to spend more. Their lifestyle rises with their income, and their savings never increase. What once felt like abundance becomes the new normal, and the feeling of never having enough returns, no matter how much more they earn. Avoiding lifestyle creep is essential. It requires discipline and self-awareness. It means being okay with not upgrading every time you can. The key is to build a gap between income and expenses, and to protect that gap. Housel also points out that the ability to save is a skill, not just a habit. It requires resisting temptation, setting boundaries, and being clear on what truly matters to you. It also means being okay with delayed gratification. That's not always easy in a culture that rewards instant results. But saving isn't about depriving yourself. It's about making sure your future self has options. It's about putting yourself in a position of strength, so that when life surprises you, and it will, you're ready. At its core, saving money is about control. It's about building a system where your decisions are based on your values, not your limitations. You don't need to be rich to save. You just need to value freedom more than appearance. That quiet choice, made consistently, is what builds lasting wealth. Managing money isn't just about numbers, it's about emotions, and that makes it hard. Morgan Housel explains that the way we think and feel about money can be deeply irrational, and these patterns often lead to poor financial decisions. Even people who are smart and experienced with money can make mistakes when fear, greed, or envy take over. In theory, financial decisions are simple. Spend less than you earn. Invest for the long term. Avoid unnecessary debt. But in practice, our emotions make simple ideas difficult to follow. We are all emotional beings living in a world that constantly challenges our self-control. One of the strongest emotions that affects our relationship with money is greed. Greed is the feeling that whatever you have is not enough. No matter how much you earn or save, you want more. You tell yourself that if you could just reach a higher number, get a bigger house, or hit the next milestone, then you'll feel satisfied. But once you reach that goal, the bar moves. The next level becomes your new expectation, and satisfaction is delayed once again. This is the danger of the moving goalpost. Housel uses the example of Rajat Gupta, a successful businessman who was already wealthy, respected, and admired. Yet he got involved in insider trading and destroyed his career and reputation. Why? Because he wanted to be even richer. He risked everything for just a little more. The lesson is clear. Knowing when enough is one of the most important financial skills you can learn. Without that awareness, greed can push you into decisions that threaten everything you've built. Another emotion that interferes with good financial behavior is fear. Fear shows up during market downturns, job losses, recessions, and uncertainty. When things feel risky, it's easy to panic, to sell investments, pull money out of the market, or freeze altogether. But reacting out of fear often causes more damage than the original event itself. People who sell at the bottom of the market often miss the recovery. Those who hoard cash out of fear of the future may lose purchasing power over time. Fear shortens our time horizon and pushes us to make decisions for immediate relief instead of long-term gain. Managing fear doesn't mean ignoring risk. It means learning to act with calm, even when things feel uncertain. Then there's envy. Envy can be more dangerous than greed, because it's not about wanting more in general. It's about wanting what someone else has. Social media has made envy a daily experience. We see people buying new homes, taking expensive vacations, or sharing investment wins. It creates a feeling that we're behind, that we're missing out, or that we should be doing more. But we often forget, we're only seeing a small part of their story. We don't see the debt, the stress, or the risks they've taken. We're comparing our full life to their highlight reel. Housel warns that envy leads people to take unnecessary financial risks just to keep up, and that can lead to ruin. The best way to avoid envy is to focus on your own game. Clarify your goals, define what success means to you, and stick to your strategy. Don't let someone else's path distract you from your own. Another psychological trap is overconfidence. It's easy to believe that we're smarter than we really are, that we can time the market, predict trends, or beat the system. But history shows that even experts are wrong often. Overconfidence leads to risk-taking, trading too frequently, ignoring warning signs, and underestimating the possibility of failure. Housel suggests that humility is one of the most underrated financial strengths. Accept that you don't know everything. Plan for things to go wrong. Leave room for error. Financial survival is more important than perfection. You don't need to be right all the time. You just need to stay in the game long enough for your strategy to work. Lastly, Housel reminds us that most people don't think about money logically because money touches every part of our lives. Our upbringing, our self-worth, our hopes, our fears. It's deeply emotional, and emotions are not easily controlled. The goal is not to eliminate emotion from financial decisions, but to recognize how emotions influence behavior, and to build habits that keep you grounded. This includes having an emergency fund, avoiding lifestyle inflation, investing automatically, setting clear goals, and regularly reminding yourself why you're doing what you're doing. By creating systems that account for your emotions instead of fighting them, you increase your chances of long-term success. Financial intelligence isn't about IQ. It's about managing your emotions when it matters most. One of the most powerful ideas in the psychology of money is that time is the single greatest factor in building wealth. It's not timing the market. It's not having insider information. It's not even earning the highest possible returns. It's patience. Morgan Housel explains that compounding, the process of generating earnings on both your original investment and on the accumulated earnings from previous periods, is what truly builds wealth. But compounding only works when you give it time, and most people don't. We live in a world that rewards speed, fast results, quick wins, overnight success. But money doesn't grow that way. It grows slowly, almost invisibly at first, and then suddenly, over long periods. Housel uses the example of Warren Buffett. He is one of the richest people in the world, but not just because he's a great investor. It's because he started investing when he was a child and kept doing it for over 75 years. In fact, the vast majority of Buffett's wealth came after his 60th birthday, not because he changed his strategy, but because the magic of compounding finally had enough time to show its results. This is what people often miss. They want big results fast, and when that doesn't happen, they change strategies, chase new trends, or give up entirely. But wealth building is not about finding a perfect strategy. It's about finding a good one and sticking with it long enough for it to work. Time matters more than rate of return. Earning 8% annually for 30 years will grow your wealth far more than earning 20% for just a few years and quitting. Staying invested, continuing to save, and not panicking during downturns is what separates those who build wealth from those who don't. But patience is hard, especially when it feels like everyone else is moving faster. The world is filled with stories of people making money quickly. Tech entrepreneurs who became billionaires overnight, crypto millionaires, real estate flippers. These stories create a false sense of what's possible and how fast wealth should happen. But Housel reminds us that those stories are the exception, not the rule. And chasing exceptions often leads people to take unnecessary risks that backfire. The better approach is to design your financial plan around what works most of the time, for most people, not the outliers. And what works is long-term thinking. This means accepting that the path won't always be smooth. Markets go through ups and downs. There will be setbacks, recessions, unexpected expenses. But that's part of the process. If you can stay consistent during the hard times, your patience will be rewarded over time. Another key point Housel makes is that getting wealthy and staying wealthy are two different skills. Getting wealthy may require taking calculated risks, being optimistic, and seizing opportunities. Staying wealthy requires a different mindset, one of caution, humility, and the understanding that the future is always uncertain. To stay wealthy, you need to avoid ruin. This means not taking on too much risk, not overextending yourself, and always leaving room for error. The most important thing is survival. If you can stay in the game long enough, compounding will do the heavy lifting. This is why financial plans should be built with a margin of safety. Don't assume everything will go right. Plan for what could go wrong. Leave space in your budget. Keep some cash reserves. Avoid betting everything on a single outcome. It may feel conservative, but it's what allows you to endure. And enduring is the only way to grow. Finally, Housel emphasizes that patience is not just a strategy, it's a competitive advantage. Most people can't stay the course. They panic. They switch plans. They give up when results are slow. If you can be the person who sticks to a sound plan, ignores the noise, and gives time for your money to grow, you're already ahead of most people. Long-term thinking doesn't guarantee success, but it increases the odds dramatically. And in personal finance, that's often what matters most. Success with money is not about speed, it's about endurance. And the reward for enduring is the quiet power of compounding. Slowly, steadily turning small actions into lasting wealth. Throughout The Psychology of Money, Morgan Housel emphasizes that managing money well isn't about mastering complex theories or chasing the highest returns. It's about consistently practicing a few key behaviors, the kind that are simple in concept but difficult to maintain over time. One of the first behaviors he highlights is the importance of being reasonable over being perfectly rational. Many financial decisions are presented as black and white. What's the mathematically optimal choice? What has the highest expected return? What the data says you should do? But people aren't robots. We make decisions with emotions, values, fears, and dreams. And that's not something a spreadsheet can account for. For example, the rational move might be to invest every extra dollar, down to the last cent. But a reasonable person might keep more cash on hand than necessary, simply because it makes them feel secure. They sleep better knowing they have that safety net, and that peace of mind is worth more than a few percentage points of return. The takeaway is clear. The best financial plan is the one you can stick with, not the one that looks perfect on paper, but breaks under emotional pressure. Another behavior that matters is leaving room for error. Housel explains that most financial plans fail not because they're bad, but because they assume everything will go according to plan. But life rarely works that way. Jobs are lost, health emergencies happen, markets drop, unexpected expenses arise. If your financial strategy doesn't include a margin for error, a buffer zone, then one disruption can throw everything off course. That's why having cash savings, diversified investments, and flexible spending habits isn't just cautious, it's smart. It protects you from being forced into bad decisions when things go wrong. Closely related is the behavior of frugality, or more specifically, living below your means. This doesn't mean being cheap or denying yourself everything. It means creating a consistent gap between what you earn and what you spend, and using that gap to build wealth. It's one of the oldest financial principles, but it's often overlooked because it feels too simple. There's nothing flashy about it. Yet over time, it's one of the most reliable ways to build financial independence. Living below your means gives you control. It removes pressure. It opens doors. And it gives you the freedom to say no to a job you don't want, a deal that doesn't feel right, or a lifestyle that doesn't serve you. Housel also encourages people to define their own game. In personal finance, not everyone is playing the same game. Some people are trying to retire early. Others are building generational wealth. Some are optimizing for security. Others are comfortable with high risk and high reward. The problem is, people often make decisions based on what they see others doing, without realizing those people are playing a completely different game. Copying someone else's strategy without knowing their goals, timeline, or risk tolerance is a recipe for confusion and regret. That's why it's so important to be clear about your own financial goals, and to make decisions based on what matters to you, not what's trending or popular. Another critical behavior is consistency. You don't need to make perfect choices. You need to make mostly good choices and keep making them for a long time. Saving a little bit regularly. Investing automatically. Reviewing your budget once a month. These small actions compound over time and lead to real results. Most financial success comes not from big wins, but from avoiding big mistakes. It's about not blowing up your strategy when things get tough. It's about not chasing every hot stock or business idea. It's about showing up again and again, even when the results are slow. Finally, Housel returns to a simple truth. We're all different. What works for one person might not work for another. Some people are more comfortable with risk. Others need more stability. Some are motivated by freedom, others by security. There's no universal formula for financial success, but there are behaviors that increase your chances, no matter your goals. Be consistent, be cautious, leave room for error. Live below your means, make peace with uncertainty, and play your own game. These aren't strategies for outperformance. They're strategies for resilience. And in a world where the future is always uncertain, resilience is what keeps you in the game. As The Psychology of Money comes to a close, Morgan Housel leaves readers with one of the most important insights in the book. Personal finance is personal. There are no universal rules that apply to everyone. What works for one person might be completely wrong for someone else, not because of ignorance or error, but because of different goals, values, fears, and life circumstances. We all come from different backgrounds. Some people grew up with scarcity. Others grew up surrounded by wealth. Some are motivated by freedom. Others seek security. Some want to retire early. Others love their work and plan to continue for decades. That's why copying someone else's financial decisions, whether it's a friend, a relative, or a financial influencer, can be dangerous. You may end up playing a game you don't even want to win. Housel reminds us that defining your own game is essential. Ask yourself, what does success actually mean to me? Do I want more time? More flexibility? A bigger safety net? More ability to support my family? Once you know what you value, you can design your financial behavior around it, and let go of what doesn't serve that vision. He also emphasizes the importance of being aware of how we view risk. Some people are comfortable taking big swings, knowing they could either win big or lose everything. Others prefer slow, steady progress and would rather avoid volatility altogether. Neither approach is right or wrong. They're just different. But problems arise when people are forced into strategies that don't match their risk tolerance or emotional resilience. For example, if you're someone who panics during market downturns, a high-risk investment strategy, even if it promises high returns, might not be sustainable for you. You'll end up abandoning it at the worst possible time. In contrast, a lower return but emotionally sustainable strategy will often work better in the long run, because you'll actually stick with it. The best financial plan isn't the one with the highest return. It's the one you can live with over time. Housel also returns to the idea of freedom. Not just the ability to spend money, but the ability to control your time. He argues that real wealth is the ability to wake up and decide what to do with your day. It's the option to say no, to walk away from something that doesn't feel right, to make choices without being trapped by financial obligations. That kind of freedom can't always be seen or measured, but it's deeply valuable. And the path to that freedom is often built through small, quiet habits. Spending less than you earn, avoiding debt, saving regularly, investing with patience, making decisions that align with your own life, not someone else's expectations. Finally, Housel warns against chasing certainty in a world full of unknowns. Markets will rise and fall, jobs will come and go. Unexpected expenses will show up. Opportunities will appear out of nowhere, or disappear without warning. You can't control the future, but you can build a life that's flexible enough to handle whatever the future brings. That means leaving room for error, having backup plans, not assuming today's conditions will last forever, and being okay with the fact that you won't always make the perfect financial move. Success with money isn't about avoiding mistakes. It's about building a system that can survive mistakes. In the end, the psychology of money isn't about how to get rich. It's about how to think clearly and behave wisely when it comes to money. It's about understanding yourself, your tendencies, your fears, your values, and making financial decisions that reflect that understanding. Money touches every part of our lives. It affects our relationships, our health, our stress, our choices. So learning to manage money well, not just technically but emotionally, is one of the most important skills anyone can develop. And like all meaningful skills, it's not about mastering a formula. It's about building awareness, staying consistent, and adjusting along the way. You don't have to be perfect. You just have to keep going, with patience, humility, and clarity about what matters most to you. That's the real power behind the psychology of money.